Hello traders, welcome back to my channel and welcome to Option Series episode 2. And in this episode we're going to understand some terminologies, and this is very important for you guys because if you understand the terminologies properly, you will understand all the topics of options properly. Okay, in this episode we're going to see what is strike price and what is underlying price, and we're also going to discuss about the option settlement process, and we're going to talk about option expiry and option premium. Okay, so before discussing strike price, I want you guys to understand the basic of call and put option. Okay, so for this let us consider the example of Reliance and let us consider the current market price to be 2000. Okay, and if you guys are expecting the current market price above, that means you are expecting the price to go up, you have to buy a call option. And if you are guys expecting the price to go below, you have to buy a put option. Okay, so this is a basic understanding of call and put option, and don't worry guys, I'll make you a in-depth video on call and put option in future and further. So now you have to understand this much. So we're going to talk about strike price now. So here in this chart you guys can see the Reliance, it is a Reliance chart, and we have considered the current market price to be 2000. And if you want to buy the call option and you are expecting the price to go up, you have to buy a call option. Okay, and if you are expecting the price to go above 2100, you have to buy the 2100 call option. Okay, we're going to understand this topic by talking about the gold trade that I have explained in episode 1. And if you guys haven't watched that episode 1, please check it out. I'll leave the link in the description below. In that gold trade, the option buyer was expecting the price to go about 10 lakh rupees. So he made a contract on 10 lakh rupees. Okay, so we can consider the 10 lakh rupees as a strike price. Okay, so in this example of Reliance, you guys are expecting the price to go above 2100, so you have to make an agreement or contract on 2100 value. Okay, so you're going to buy the call option of 2100 value, so we're going to call it as 2100 strike price. So it is same for the put option. So if you guys want to buy, so if you guys want to or expecting the price to go below 1900, you have to make an agreement on 1900 value. So the 1900 will be a strike price. Okay, so the next thing is, you guys can get a question that in this chart, is the difference between the strike price will always be 100? No, it will be not like that. So here it is a screenshot that I have taken from NSE website, and don't worry guys, I will also make an in-depth video how to use NSE website and what is option chain. Okay, if you guys see closely in this option chain chart, this blue values is known as strike prices, and if you guys see carefully, there are only 20 points difference between the strike prices. Will it be same for all the stocks? No, and these difference between the strike prices are made by the exchange, and they decide the difference between the strike price, and it will vary stock to stock. Okay, and next comes the terminologies like ITM, ATM and OTM. These are the short forms that we use in strike prices. Let's see what are these. ITM is called in the money strike price. For example, if consider the Reliance current market price to be 2000 and the strike prices comes below the current market price, we call it as ITM strike prices. For example, 980, 960, 940 and 1900. Okay, and ATM is called as at the money contracts or at the money strike price. Okay, so if the Reliance current market price is 2000, then the strike price at the current market price is considered as ATM strike price. Okay, and the OTM is known as out of the money contracts or out of the money strike price. So all the strike prices which comes about current market price here, which is 2000, is known as out the money contracts or out the money strike prices. For example, 2020, 2040, 2060 and 2080. Okay, and the next terminology is underlying price. Okay, so let us talk about the example of gold trade, which we talked in episode 1. There we talked that the underlying asset was the gold and the agreement was the derivative. okay, and obviously the underlying price will become the price of the underlying asset, okay. So if the option buyer wants to make more profit, the underlying price has to increase above his strike price. That is, the out of the money option or the ATM strike price has to become ITM, okay. I will explain these things in detail in further video. Don't worry about that if you don't understand that thing. In the example of Reliance stock is the underlying asset, and the Reliance stock price is considered as underlying price. And if the option buyer wants to make more profit, the underlying price has to increase more than its underlying strike price, okay, and it will be opposite for the option seller. The next terminology is expiry. In the example of gold, they made a contract for 1 month. After 1 month, it is known as expiry. So if the gold buyer wants to make profit, the underlying price has to increase the strike price after the expiry, okay, and it will be opposite for the gold seller. If the gold seller wants to make profit, the underlying price shouldn't increase above the strike price within the expiry, okay. And in the example of Reliance, it is same as the gold. Whatever the option buyer wants to make profit, the current market price of the Reliance has to increase above his strike price within the expiry, okay, and it will be opposite for the option seller. And for the stock options, there will be expiry on every Thursday of the last week of the month, okay. And you guys can make a contract, or you guys can trade contracts of this month, next month, and for a month, okay. The next terminology is option premium. In the example of gold, I've also discussed this topic in episode 1. Here we're going to talk in little detail. In the example of gold, 1 lakh rupees was the premium, okay, and this premium will be affected on different factors. If the gold trade was for about 2 months or 3 months, the option premium will obviously be increased, because there will be high chances that the gold price will increase in a long duration of time. In the example of Reliance, even the premium of stocks will be decided on different factors. Some of the factors are time and volatility, and these factors are considered as Greeks. And don't worry guys, I will make an in-depth detail on Greeks too. And some of the examples, like the premium will be higher if the expiry is for example, if you buy the option of this month and if you buy the option of next month, if you compare, the 4 month option premium will be more than this month premium, okay. And if you buy the option of in the money or at the money, and if you observe the premium of the money, the in the money and at the money premium will be higher when compared to OTM, okay. And the next topic will be the process of option settlements, and this topic I'm going to explain in after some videos, because you guys have to understand some topics in detail to understand that process, okay. And that's all for today guys. Let's meet in the next video. Thank you guys for watching.